In today's market update video, we're going to be focusing on only one instrument, the S&P 500, working with SPX data. The reason I'm focusing on only one instrument is so that we can delve a little deeper into the details. I've received some fantastic feedback. Thank you very much to all of you who have provided feedback recently. I'm delighted to hear that you find these market updates useful. And on the basis of that feedback, we're going to be delving a little deeper into some of the details and spending less time discussing alternative analysis possibilities or getting lost in the woods of the analysis. I do hope that you find this interesting. So here is the analysis we've been looking at for some time in the S&P 500, and I'm not going to start with a bigger picture view because I have expressed that view in earlier market update videos. I will provide a link in this YouTube video so that you can follow that and take a look at the bigger picture and update yourself as to what it is that we're actually looking at. The detail that I'm going to delve into in today's video is again to do with the FLD. The FLD is an acronym for Future Line of Demarcation. It is a cycle tool that was discovered or developed or defined perhaps by Hurst in the early 1970s. In fact, he mentioned the FLD in his book, The Profit Magic of Stock Transaction Timing, which he published in the late 1960s. And so it is something that he was working with over 50 years ago. The FLD is in fact a very simple tool. It is nothing more than the median price, and we can display the median price here. There is the same data displayed as median price. Median price is of course the mid price between the high and low of each bar. And so the median price is displaced to the right on your chart, and that results in the FLD, as I think you can see here. How much should you displace the median price to the right? That depends on the cycle upon which you are basing your FLD. Yes, there is an FLD for each and every cycle in our analysis. We are looking here at the FLD for the 20-day cycle, and the median price is displaced by half of the recent average wavelength of that cycle plus 1 bar. That is the formula that was defined by Hurst over 50 years ago when he originally defined the FLD. Now, Hurst discussed several features of the FLD, including the way in which it can be used to confirm an analysis proposition that you have, such as the formation of a trough or a peak. And he also discussed the targets that can be calculated as a result of price crossing over an FLD or down below an FLD. When I started trading with Hurst cycles, I enthusiastically started trading these price interactions with the FLD. And I noticed that sometimes a price interaction resulted in price accurately achieving its target, which was what I expected on the basis of what Hurst had said about the way in which price interacts with these FLDs. But there were other times, and there isn't an example for me to illustrate on this chart, where price would come down to an FLD, touch it, potentially cross it, perhaps only for a few hours on an intraday bar, and then reverse direction. In other words, the FLD would provide support, or if it was above price, it would provide resistance. This discovery fascinated me, and it led me to explore the FLD in greater depth. The result of that exploration is a trading strategy that we call the FLD trading strategy, which trades a sequence of interactions between price and the FLD. There is a link in the description below this video with more detail about the FLD trading strategy, but what we're going to focus on today is what we are expecting to happen next on the basis of the FLD, which is of course based upon the analysis that we see at the foot of our chart. And I'm going to add in the composite model line and discuss how that can help us to understand what we are expecting to happen next. So let's start with this analysis that we see on our chart before us. First of all, we have identified the fact that there is an 80-day cycle trough that formed over here towards the end of October. Now, you will know, if you've been keeping up to date with these market update videos, that this might indeed be a bigger magnitude cycle trough, a 20-week or a 40-week cycle trough that could have formed. Many people who are new to Hurst cycles find that a bit disconcerting, that I say this is an 80-day cycle trough, but it might be a greater magnitude cycle trough. I would encourage you to put aside your concerns about that, because in the course of this video, I am going to explain why it is that the exact magnitude of that cycle trough is not of utmost importance in terms of us understanding what we are expecting over the next week or few weeks, which is the time frame that we are looking at in these market update videos. The important thing is that this is a trough of at least 80-day magnitude. Following a trough of at least 80-day magnitude, we expect a sequence of interactions between price and the 20-day cycle FLD. People often ask me whether the same thing applies to other FLDs. The answer is yes. You can work with any cycle FLD. The sequence does differ slightly when the harmonic ratios between the nearby cycles is not a simple 2-to-1 ratio, but we're not going to go down that rabbit hole in today's video. Following the trough of at least 80-day magnitude, the first interaction between price and the FLD is where price crosses above the FLD, and we label that an A category interaction. That generates a target to the upside, which I discussed in last week's video as well. That target was reached, and as you can see, it was slightly exceeded before the 20-day cycle trough formed in the market. Now here are the diamonds marking the time at which the 20-day cycle trough formed. In last week's market update, I suggested the possibility that this might be a 20-day cycle trough, and indeed now with the extra data that we have gained over the past week, we can confirm that that was a 20-day cycle trough. Now, there is an interaction that is expected to occur at the time of the 20-day cycle trough. That interaction is where we expect price to find support at the level of the 20-day cycle FLD. Did price find support? Well, it didn't even come down to the level of the FLD. What does that tell us? That piece of information tells us that the market is bullish. It is more bullish than a simple balanced market. What does that bullishness mean? What it might mean is that there are longer cycles than the 80-day cycle that have recently formed a trough. And so that piece of information increases the chances that the magnitude of this trough at the end of October is greater than 80 days. As price moves down into the 20-day cycle trough, it often touches the FLD in what we label a B category interaction. Even if price does not touch the FLD, as in this case, we still label that a B category interaction. I describe the interaction as price moving towards the FLD as opposed to actually touching it. The B category interaction is paired with the next interaction, which is labeled a C category interaction. You can see it's not really very complicated, the labeling system that we use, and that is what happens when price bounces out of the 20-day cycle trough. The C category interaction, as a matter of interest, provides very good and very reliable trading opportunities because of the fact that you have already witnessed an A category interaction, seen price reach the target, thereby confirming that the trough you were expecting to form has indeed formed, and the fact that price finds support at the level of the 20-day FLD or finds support above the level of the 20-day FLD gives you further assurance that there is bullishness in this market. Now, what are we expecting to happen next? The next letter in the sequence is, of course, the letter D, and that is when price is expected to cross down below the 20-day FLD on its way down into the 40-day cycle trough. So let's speak for a moment about this 40-day cycle trough. Here I have drawn an inverted triangle over what we call the nest of lows. The nest of lows is made up of the circles and whiskers of each one of these cycles. A circle and whisker is simply the exact time at which the next trough of a particular cycle, and you can see our cycles are color-coded, so I've just pointed at the 40-day cycle circle, and that is the exact time at which the next 40-day cycle trough is expected to occur on the basis not of the average wavelength of the 40-day cycle, but of the recent average wavelength, which is presented at the right-hand edge of the chart, as Hurst suggested, where you can see that the recent average wavelength of the 40-day cycle has been calculated at 36.8 days. That is only about 2.5 days longer than the average wavelength of the 40-day cycle, which was discovered by Hurst 50 years ago. You can see that in this nest of lows we have neatly lined up circles for the 20-day, the 10-day and the 5-day cycles on the 29th of November, whereas the 40-day cycle circle is a little displaced to the right. The reason for that is because the recent average wavelengths of the 20-day and shorter cycles has been calculated to be a bit shorter than the recent average wavelength of the 40-day cycle. Why might that be, as a matter of interest? When cycles form troughs early, it is an indication that the market is bullish, and there has therefore probably recently been a change in the tone of the market because of the formation of a longer cycle trough. And there are no surprises in that information, because here, of course, is that longer cycle trough in the market. Therefore, we would expect this 40-day cycle trough to occur more on the earlier side, as opposed to the later side of this nest of lows. When price crosses down below the 20-day cycle FLD, it will generate a target to the downside. We cannot calculate that target yet because we haven't seen price cross down below the 20-day FLD. But we are certainly expecting a move down into the 40-day cycle trough. And so this is how we use the FLD to understand what to expect out of this market. How you choose to trade it is, of course, up to you. But the obvious way to trade a market is to identify whether you are interested in taking long trades or short trades. At the moment, I would not be particularly interested in a short trade because of the possibility that this is a very big cycle trough that formed. And so we are looking at long trades. We would currently be in a long trade waiting for the 40-day cycle peak to form, after which we would watch the market as it comes down into the 40-day cycle trough, which would give us our next opportunity, if this was a time frame that we were interested in trading, for entering into another long trade as price bounces out of the 40-day cycle trough. Now, if looking at these diamonds and circles and whiskers on the chart is a little confusing, there is a useful tool in Sentient Trader called the composite model line. The composite model line simply takes the information from the analysis that has been performed. It recomposes that information, including the cycle wavelengths and the amplitude, and it shows us in the past what would have happened if the only thing influencing this market were the cycles that have been found in the analysis. As it moves into the future, the composite model line shows us what to expect on the basis that those cycle wavelengths and amplitudes will remain constant. Something to bear in mind is that cycle wavelengths and amplitudes never do remain constant, and so we always need to treat the composite model line with a little bit of a pinch of salt because of the fact that those cycle wavelengths and amplitudes are going to change. Nevertheless, the composite model line provides us with very useful information, a very useful way of visualizing the implications of the analysis. You can see the implications provided by the composite model line are that the 40-day cycle peak is due or was expected to form towards the end of last week. Here you can see price is expected to cross down below the 20-day FLD at about this level and pretty much over the Thanksgiving weekend, which is coming this weekend ahead of us. Then price is expected to reach down and form a 40-day cycle trough. It is no surprise, as a matter of interest, that the composite model line lines up with the nest of lows. It is no surprise because, of course, the composite model line is based upon that analysis. And so the composite model line reinforces our expectation that the 40-day cycle is going to form a peak in this market, and then price is expected to come down into a 40-day cycle trough. Now there is another FLD that we can look at. Let's turn our composite model line off for the moment and consider the 40-day cycle FLD. That blue line is the 40-day cycle FLD. So here is an interesting point to be made about this FLD. If the trough that formed at the end of October was of at least 20-week magnitude, then we would of course expect price to find support at the level of the 40-day FLD at the time that the 40-day cycle trough forms. I hope that the explanation I have provided in this video helps you to understand why that is. As a very quick summary, here is our first interaction between price and the 40-day FLD. It is an A category interaction. We would expect the same B and C category interaction pair to form at about the level of the 40-day cycle FLD at the time that the 40-day cycle trough forms. If we display our composite model line again, you can see that the composite model line expects price to come perhaps a little below that 40-day FLD, but bear in mind the fact that the composite model line is based on the fact that these cycles are going to continue beating with the same wavelengths and amplitudes, and that of course will not be true. Therefore, I will certainly be focusing very much on the 40-day cycle FLD at about the time that we're expecting that 40-day cycle trough to form, and looking for evidence that the 40-day cycle FLD is providing support. But now what if this trough that formed at the end of October is not of greater magnitude than the 80-day cycle? Despite the fact that we have some evidence that it is of greater magnitude in the increased bullishness that we have seen, and the fact that price didn't even reach down to the 20-day FLD to find support at that FLD. If despite that, the trough that formed at the end of October is of only 80-day magnitude, what would we expect then in terms of this 40-day cycle FLD? If that is the case, then this interaction between price and the 40-day FLD over here would be labeled an E category interaction. The next interaction would of course be an F category interaction, which is not where we would expect price to find support at the level of the FLD, but where we would expect price to cross down below the FLD on its way down to the next 20-week cycle trough. And so that is why I said earlier, I am not too worried about confirming the magnitude of this cycle trough at the end of October, because we already have a very clear expectation of what price is expected to do over the next week. And when price bounces out of this 40-day cycle trough, we can watch that very carefully and come back and confirm the magnitude of this cycle trough once we have seen the level of support that is provided by the 40-day cycle FLD. I do hope you found this more detailed market update video of interest and useful to you. Please let me know if you have any questions by putting them in the comments below the video, or join us on our Hurst Cycles Discord server. I look forward to hearing from you.